So the last major financial crisis occurred in 2008 when the S&P 500 dropped by around 57%. It was a time of fear, uncertainty and big losses, leading many investors to fear experiencing such a downturn again. And last week I stumbled upon a YouTube video with over 350,000 views, and it began with a stark warning like this.
In 2007, the unemployment rate rose by 50 basis points in the 6 months leading up to the global financial crisis. In 2000, the unemployment rate also rose by 50 basis points in the 6 months leading up to the 2001 recession. Today, over the last 6 months, we've seen the unemployment rate rise by 50 basis points. The most recent unemployment rate number came in at 4.3%, with US unemployment now clearly showing signs of gaining momentum to the upside, something that history shows only happens either right before or during economic recessions in the US. And as I'm going to show you in this video, that's exactly the direction that we're heading into, which is going to have absolutely massive consequences for the stock market. This recent unemployment rate number is already creating panic, something that we think can be taken advantage of. The unemployment rate isn't the only economic data point that's pointing to a recession right now. This is a chart of the VIX. It's the volatility index of the S&P 500, and it has spiked to the highest level since COVID, since 2020. It went from an incredibly low level back in July to now a level only comparable to 2020 and the 2008 financial crisis. An absolutely insane move, showing us investors are in a complete state of panic right now, dumping their stocks on recessionary fears. Now, the question is whether we should be panicking along with all of these investors.
In this video, we will answer the question, can investors predict upcoming market crashes, and what steps should you take if you are already invested your money when the market drops? So I dug deeper into the history of market crashes, because if those experts are right and history does repeat itself, we could be in for a rough ride, right? I mean, during the Great Depression, we saw the market fall by an 86%, and it took almost 25 years to recover. Black Monday in 1987, a 33% drop. The dot-com bubble, the 2008 financial crisis, and even the 2020 pandemic crash all had their own stories of devastation where a lot of average traders and investors lost a lot of money. But here is the real problem. When you do a deep dive into stock market crashes in the past, you will notice that market crashes do not follow a strict, predictable timeline. They are all different. And this is what a financial expert, Jack Bogle, a legendary person in the financial industry with over 67 years of experience and the founder of Vanguard, have to say about this.
And this last 50% decline, one of I think 4 I've experienced, they're all different. That's one really important thing. Don't say I've seen all this before. Very few times does the same thing happen twice, and in the financial markets. The same problems happen twice. Yeah, each one is its own. There's some statement like, all happy families are alike and all unhappy families are different, but all unhappy families are alike in their own way, or something like that. And the problem here is that all these bear markets are very, very different, inspired by different things, sometimes mathematics, sometimes investors' emotions, and sometimes by external factors.
So are you able to identify market crashes before they're even happening? A lot of investors are predicting that a market crash is ahead. When you see all these data, you probably are thinking, this sounds like a decent story, right? So let's dive deeper into the channel I just mentioned, because I realized that there is a recurring pattern if you look into their data. When you look at this channel, for example, the oldest videos are from 5 years ago, and you see the thumbnails like these. The most popular video went viral 10 months ago, and it went something like this. History is repeating. This won't end well in 2023. So here's the funny part. These predictions of doom are what you can see have been coming over the last 5 years. If you tell people every month that it's going to rain tomorrow, eventually you will be right one day, right? Because if you look into the data of the stock market over the last 80 years, you see the market will rise 75% of the time and goes down 25% of the time. So yes, you could lose a lot of money during a bear market, but if you stay long enough in the market, and I talk about a minimum of 7 to 10 years, your chances of losing money is almost zero. And in this video, I talk a lot more about returns and market crashes. But a lot of those experts or gurus are using technical analysis, secret formulas, and special systems to prove their points. So be careful who you trust with your money. So the question is, and I get this a lot these days, are experts able to forecast the market, and could they consistently outperform the market with their special system over the long run? But to answer this question, I want to give you some important insights from the financial industry. And this phenomenon has called the zero sum game. So what does this mean? Jack Bogle explains it this way.
Because we trade with each other. There's no gain to be found for the market. I trade with you, I may be right or wrong, you may be right or wrong, and there's only one person that makes money, the croupier in the middle. There has to be something to sell all the time in Wall Street. And you know, with all due respect, I mean, it's an honest trade, but there's just too much of it going on, and it can't win. Because if trader A wins, I mean, I don't want to beat this to death, but I might as well make it clear. Trader B loses. And so trading is a loser's game.
So in the end, activity, especially trading, is a loser's game, and most people will lose money in the long run. And if you are smart, you are asking the question, what kind of business model are traders using to earn money? Because let's be honest, we all have that gambling instinct where we want to earn money fast that strokes our ego, right? This is what Jack Bogle advises to do.
Well, on the second part, I've often said, a little bit tongue-in-cheek, that part of the romance of investing is the gambling instinct that we all seem to have, or that so many of us seem to have. And so you ought to have a funny money account, not a penny more than 5% of your assets. Do anything you want with it. Buy a stock, buy a commodity, buy a Bitcoin if you want to, if you're crazy. And by the way, the Bitcoin may well go to 20,000, but that won't prove I'm wrong. When it gets back to 100, we'll.
How about a Chinese equity?
Sure.
Or a Chinese tech stock?
In the funny money account, anything you want. One requirement: look at it after 5 years and compare it with your serious money account. And if you're doing much better, you may be some kind of a genius, but I'd stop anyway. And if you're doing badly, just realize this is a hard business and don't go any further.
But Maurice, what about investors like Warren Buffett, who have been able to outperform the market over long periods of time? Isn't he living proof that you can successfully time the market? Well, yes and no. Let me explain. Yes, Warren Buffett has achieved compounded annual gains of 19.8% from 1965 to 2023 with his company Berkshire Hathaway. So he significantly outperforming the S&P 500's 10.2% return over the same period. And this is a massive outperformance, right? Yet, Buffett also has said that most investors will not achieve significant success. He has noted that about 98% of investors may fail, while only 2% will see notable success. Warren Buffett also has consistently emphasized that he does not try to predict short-term market movements or market crashes. Instead, he focuses on evaluating individual businesses and their long-term value. Buffett buys high-quality companies with strong fundamentals and holding them for the long term rather than trying to time the market. However, it's important to remember that while track records can provide insights, predicting market crashes with certainty is extremely challenging, and no strategy guarantees success. Extensive research indicates that in the industry of actively managed funds, where experts attempt to time the market, fewer than 10% have been able to consistently outperform the market for more than 15 years in a row. And I have had the same experience. I've been in the financial industry for over 15 years now, and I've talked to a lot of asset managers and so-called experts with the greatest stories and so-called proven systems. But in my experience, 99% of the time, they will fail over the long run. So yes, it can be challenging to achieve a 10% return on your investments, especially with distractions from the news, YouTube channels, and self-proclaimed gurus. That's why we are sharing the 26 most valuable lessons Jack Bogle learned from his 68 years of investing in this video. These timeless lessons from a true investing pioneer can help you cut through the noise and focus on proven strategies for long-term success.